A bear market is when a market experiences prolonged price declines. It typically describes a condition in which security prices fall 20% or more from recent highs amid widespread pessimism and negative investor sentiment. We are currently experiencing the 22nd bear market since 1929, so while they don't happen frequently, they are definitely a normal part of being a long-term investor. Here are the different phases in a bear market. The first phase is characterized by high prices and high investor sentiment. Towards the end of this phase, investors begin to drop out of the markets and take in profits. In the second phase, stock prices begin to fall sharply. Trading activity and corporate profits begin to drop, and economic indicators that may once have been positive start to become below average. Some investors begin to panic as sentiment starts to fall. This is referred to as capitulation. This is also the phase that we are currently in. The third phase shows speculators start to enter the market, consequently raising prices and trading volume. In the fourth and last phase, stock prices continue to drop, but slowly. As low prices and good news start to attract investors again, bear markets start to lead to bull markets. Now, let's take a ride through time. Starting from the year 1929, the percentage decline in the S&P 500 during that year was 44.7%, with the numbers of days from peak to trough 67. The next year had a percentage decline of 83%, with the number of days from peak to trough 783. I will not be going through every year, however, you can pause the video and take a look. As you can see from the table, the average bear market since 1929 has resulted in roughly 37% decline in the S&P 500, and it has taken an average of 344 days or nearly a year for the market to reach its bear market bottom. If these averages were to play out during the current bear market, investors would expect the S&P 500 to fall to around 3017 or a roughly 22% decline from mid-July levels. The average duration from peak to trough will mean the market could bottom in mid-December 2022, based on its peak of January 3rd, 2022. So how do you act and take advantage of these current market conditions? Firstly, think of this as an opportunity, because it really is. For many long-term investors, bear markets end up being more of an opportunity than anything else. Bear markets are a great time to invest additional money into the market because prices have declined substantially, which allows you to get more value for your money. These can be psychologically difficult to do because it's counterintuitive to invest when so many people are talking about the risks the economy faces. But when people are hyper-focused to these risks, they sell stocks, which can then create bargain investments for stable-minded investors. As legendary investor Warren Buffett has said, "The future is never clear. You pay a very high price in the stock market for a cheery consensus." Secondly, make dollar cost averaging your friend. Say the price of a stock in your portfolio slumps 25% from $100 a share to $75 a share. If you have money to invest and you want to buy more of these stocks, it can be tempting to try to buy when you think the stock price has cratered. Problem is, you'll likely be wrong. That stock may not even have bottomed out at $75 a share. Rather, it could tumble 50% or more from its high. This is why trying to pick the bottom or timing the market is a risky endeavor. A more prudent approach is to regularly add money to the market with a strategy known as dollar cost averaging. Dollar cost averaging is when you continually invest money over time and in rough equal amounts. This helps to smooth out your purchase price over time, ensuring you don't pour all your money into a stock at its high while still taking advantage of market dips. There's no doubt that bear markets can be scary, but the stock market has proven it will bounce back eventually. If you shift the perspective, focusing on potential gains rather than potential losses, bear markets can be good opportunities to pick up stocks at lower prices. Thirdly, take some time to sort out and maybe rebalance your portfolio. Speaking of picking up stocks at lower prices, boosting your portfolio's diversification so it includes a mix of different assets is another valuable strategy. Bear market or not. During bear markets, all the companies in a given stock index, such as the S&P 500, generally fall, but not necessarily by similar amounts. That's why a well-diversified portfolio is key. If you're invested in a mix of relative winners and losers, it helps to minimize your portfolio's overall losses. If only you could know the winners and losers in advance. Because bear markets typically precede or coincide with economic recessions, investors often favor assets during these times that deliver a steadier return, irrespective of what's happening in the economy. This defensive strategy might mean adding the following assets to your portfolio. Firstly, dividend-paying stocks. Even if stock prices aren't going up, many investors still want to get paid in the form of dividends. That's why companies that pay higher than average dividends will be appealing to investors during bear markets. An example of which would be the dogs of the Dow, but I'll make a separate video on it soon. Next up, we have bonds. Bonds are also an attractive investment during shaky periods in the stock market because their prices often move in the opposite direction of stock prices. Bonds are an essential component of any portfolio, but by adding additional high-quality, short-term bonds to your portfolio may help ease the pain of a bear market. Alright guys, that'll be all for this video. I hope that you have learned something new today and got a better view of the current market conditions. Thank you for staying to the end, and remember to save, invest, and win. Adders signing out.